All right, welcome everyone. In this explainer, we're going to walk through a specific application of a financial model called market DNA. We'll be looking at what it calls a phase one analysis for gold. You'll also see it referred to by its market symbol, XAU. So let's dive right in.
Now, it's really important to be clear right from the start. This is for documentation purposes only. Think of it as a public record, just a way to verify how the model is being applied. We are simply observing a process here, okay? We're not making any financial predictions.
So, the asset we're focusing on today is gold. And within this model, every single setup gets its own unique ID so you can track it. For this one, the cycle ID is XAU_1_1. This just helps keep everything organized and totally clear for verification down the line.
So that begs the question, right? How does this framework actually document a market setup? Well, we're about to see. We're going to go through the predefined steps for what's called phase one. This means looking at the initial conditions, the parameters, and the potential scenarios, all based on the model's geometric structure.
All right, let's get into the good stuff. Phase one, entry levels. This is where we look at the exact conditions that kick off a brand new cycle, according to the model. Here on the chart, you can see the starting point loud and clear. The analysis officially begins the moment the price of gold hits the primary entry level. You can see that point marked on the chart as M, and at that exact moment, the value was recorded at $3,965.03. So, here's a key detail in phase one. The model defines two distinct entry levels right from the get-go. We've got the primary entry, M, which we just saw has already been hit. But then there's a secondary entry, labeled PC, at $3,818.34. It's important to note this second level might be reached or it might not. It's just part of the initial setup. Okay, now that we have the entry points, let's look at how the model documents risk management. And these aren't parameters that are decided on the fly, you know? They are a core part of the initial phase one setup, predefined right at the very start of the cycle. First up, we have a parameter the model calls the trapezoid time duration. For this specific cycle, that's set at 38 days. We'll see how this time frame plays into the potential scenarios a little bit later on. Next, we document what the model refers to as domain percentages. The third triangle domain is recorded as 10.02%. Then, that number is multiplied by a fixed risk coefficient of 2. And that little bit of math gives us the risk domain, which comes out to 20.04%. These are just very specific inputs for the model's risk calculations. This slide gives us a risk preview calculation based on those parameters, so let's walk through it. Using a hypothetical capital of $100,000 and a maximum allowed drawdown of 5%, the model calculates a total position size of 0.06. This is then documented as being split into two trades, which makes each trade size 0.03. Now, the source documentation requires me to read this next part to you exactly as it's written. This is just to be perfectly clear about how this is all calculated. Here we go. Both trade sizes are calculated using the hypothetical capital, the investor's maximum allowed drawdown, the third triangle domain percentage, the risk coefficient, and the contract size. So, with the entry and risk parameters all set and documented, we can now turn our attention to the projected target scenarios. These are the potential exit points that the model calculates based on its own geometric structure. The model identifies three distinct price targets. Target 1, which the model calls the mirror or lower trapezoid, is at $4,009. Target 2, known as Apex N, is projected at $4,166. And finally, Target 3, the trapezoid top, is set at $4,316. Okay, let's look at the first potential outcome here. Scenario 1 is based on the assumption that only the primary entry point, M, gets triggered. It then projects a full exit from the position if and when the price reaches Target 3. So if Scenario 1 were to play out exactly as documented, the calculated expected profit would be $1,052. As a percentage, that's an expected return of 1.05%. And when you annualize that return over that 38-day duration we mentioned, it comes out to 10.08%. All right, let's now consider the second scenario. This one is based on the idea that the price actually reaches both of the entry points, M and P of C. In that case, the model projects exits at Target 2 and Target 3. Under this second scenario, you can see the numbers look quite different. The expected total profit is $2,095. That gives an expected return of 2.09%. and the expected annual return is calculated at 20.07%. So there you have it. These are the two main potential outcomes documented in phase 1 of this model. Before we wrap this up, it is absolutely essential to go over some important disclaimers. Think of these as fundamental protocols for anyone observing or documenting this model. Please take a second to really review these key points. First, and this is the most important one, this is not financial advice. This analysis is purely for public documentation and verification of the model, period. The model's protocol also prohibits using leverage above 10, and it strongly advises not to invest essential personal funds. And finally, any risk management must strictly follow the user's own instructions. And that officially concludes our observational walkthrough of phase 1 for cycle XAU_1_1. If you want to follow the public verification of this cycle, or maybe see others, you can visit the official documentation website right there on your screen. Thanks for watching.